Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 1st, 2021. I hope everybody, at least here in the States, had a nice long 3-day weekend. Markets were closed yesterday in observance of Memorial Day, and I hope everyone elsewhere had a good weekend as well. All right, I'm going to do a quick update. There's really not a lot to report on the indexes since the last few updates. We continue to grind around in this sideways trading range recently in the NASDAQ 100. We put in a slight, a marginal new high this morning in the futures shortly after the market opened, and then around right around the 10 p.m. mark, I'm sorry, the 10 a.m. mark, we had a couple economic reports came out. They came in a little hot, which helps the case for the a little additional boost for the Fed to eventually start tapering here, most likely earlier than they initially indicated. That seems to be the recent trend. So either way, that knocked the markets down. I don't know if you can make it out there. We'll zoom in real tight, but again, we're within the range now. The technicals still say divergent high. Negative divergence has been building, so it still favors a reversal as long as those divergences remain intact. And as stated last week, we need to take out the recent lows or the bottom of this sideways trading range right here, and we're flirting with that right now. We're very close. So that's what it looks like on the NASDAQ 100. We'll get to the index ETFs in just a second. Let me just cover the futures first. Let's look at ES. The S&P 500 futures, if I can call that chart up. Here we go. Same thing. Nothing changed last week. We had a little divergent high right here, and that divergence has just extended to this point. This is this morning, and there's that knockdown we had around 10 a.m. shortly after the market opened today. So yes, the S&P 500 future is still sitting above that 4179-ish support, and still likely to ultimately work its way down to, I think, these recent lows right here. That was our last divergent low. That was a catalyst for this rally, and now we have this divergent high here, just like this one there and the one before that. And now bigger picture is markets continues to grind around mostly sideways. So the opportunities lately, it's been more of a trader's market. It's been kind of hit and run, get in and out. And I'll get to some of those trades, do updates on the recent hit and run commodity trades that we had. I want to just pull up RTY first and cover that one. This is a small cap index futures, Russell 2000, and there's our most recent divergent high right here. You can see all the previous divergent highs, little divergent highs, little corrections along the way, and this is our most recent divergent high. And now we have at this point a pretty significant trend line worth watching here on the 60-minute charts that if and when broken, and that also would come in around that 2264 support level right there. It's a minor support level, but one that I've had on the chart for a while. That should open the door for a decent correction here, and I think that appears to be coming up soon on the small caps. Let's just jump over to the index ETFs. I'm going to get to this in a second, the volatility indexes, but I want to just mention the S&P 500 still below this trend line here, this primary trend line right there off the March lows, March of last year, back testing from below with a secondary trend line right about here. And the market leading tech stocks have gone nowhere now for months. This is QQQ, still below the primary trend line, but when we turn off all the lines, just call it for what it is. This is just a multi-month sideways grind, in this range right here. In fact, if we go to where we're trading right now and go back in time, we can see where exactly where we were. That's 3.9 months ago, and just a hair above, a fraction of 1%, less than 1% above where we were 4.2 months ago back on January 25th. So this has your market leaders, your Apple and Amazon, Facebook and Microsoft in there, and again, they've stalled out. So it's a common theme. I know I've been saying it for a while. So we haven't gone down, but the market's not going up. So again, there'll be swing trading ops within there, and I've posted quite a bit of those lately. Individual stocks, individual commodities, and certain sectors. And until we see the key sectors break down, or at least the key sectors did. The tech stocks already broke broke down, and we're just waiting on to get some decent sell signals in the market. You need to see financials break that primary trend line. That one comes off the late October lows, and then the industrials as well. We're right above that trend line there, and that's the trend line off the March lows. Okay, had a brief interruption there. I had to pause the video, but that's I forget where exactly I was, but that's it. XLI Industrials walking the line right there, talking about the primary trend line off the March lows. So again, until those break down, we're just going to continue to see that, or we'll likely continue to see that kind of grind in the market that kind of go nowhere. The trend in those sectors obviously remains bullish, and it remains sideways now in the tech stocks and many other sectors, as I just mentioned, for the last 4 months or so. The other things I wanted to do a quick update. Let's talk about commodities. Some of those trades proved to be some quick hit and run trades. ZW wheat. Wheat's actually, still going. That was the bullish falling wedge breakout last week. Went up, hit first, second target, took out that 678, 330 level, so we're above there, and will likely to continue to work its way up here, at least at 715 level. And as I also mentioned, that may be the the end of the correction before the next leg up. These commodities remain in a bull market right now, unmistakable strong charts, so you want to look to buy the dips and be careful about shorting. I'm more keen to just get out or stop adding to these positions when they get frothy out here. If you're a quick trader, there's nothing wrong with taking a quick short pullback trade, but I'm talking about investors. Longer term investors may just want to take note when things get a little extended, when they're at resistance or divergences, things like that, and then you get, especially once you get a sell signal, hold off, let the correction run its course, and then jump back in when you get a pullback to support. Again, these were covered on different time frames. This is just a 60-minute chart. The daily time frames and even the weekly are where you want to also align your entry points or re-entries for long-term trades or investments. So that's wheat, and I wanted to update the other ones I highlighted. That was where is corn? I had corn here somewhere. There it is. ZC corn divergent low. Moved up, but the that one wasn't mentioned. We mentioned wheat, and here it is, soybeans right there. And soybeans, beautiful little trade up about 4 to 5% off this recent divergent low, and pull back to very nice support level there, breakout back test. And just today, this is what I wanted to update. I made a static chart. I was going to post an update on the homepage, and I figure I'll just do the video. We hit that. That was a final near-term target, just a bounce target off this bullish falling wedge. Same story. You can trail stops up for the longer run, but if you're an active trader, there was an opportunity to get out at that second and final near-term target of 15.75. 50-ish right there. And when we did it, we put in a small divergent high right there, and we've so far pulled back. And you can see the same thing here on the soybean 60-minute chart of soybeans ETF or ETN SOYB. Same thing. Breakout, pull back to support, second target hit today, giving you a chance to get out at that 23.82 level. Or raise your stops and let it run. Bigger picture still has soybeans dancing or recently bouncing off this primary uptrend line, so that's certainly one to watch. If and when broken, we may get a pullback to here. And let me just digress for a second, although it's really on topic. Somebody asked today about the my whole tapping the brakes theme or theory, so to speak, and that is the Fed would soon, and this was of course a couple months back that I first predicted this, soon start to slowly tap the brakes, and it wouldn't be, Powell's not going to come out and do a quarter point or a half basis point, or 50 basis point, 0.5% rate increase right off the bat and shock the market. That is the antithesis of this Fed. This Fed will not do any surprises to the market. They made that clear. And so, but what they are doing is you're seeing one, Fed member after another kind of mentioning, there's a little bit of concern, and we may need to start, address the possibility of, their initial talks are really more so of tapering the bond purchases. That's the other part of their easy money policy. You have the zero interest rate policy, and then you have the bond purchases. So we're seeing that, and we continue to see that. Now, where I'm going is the question was, once that becomes, and I expect that then the rhetoric will go up more and more. You'll hear more and more buzz about that, and as you do, there'll be a point where it is likely to start putting pressure on these commodities. So. And the question was put to me in one of the comment sections today or over the weekend. Is that what's it gonna do to commodities? Well, all other things being equal, that is not bullish for them. That will be bearish, and it probably will trigger a correction. But again, it's so far everything's been incremental. And my answer was basically we just watch the charts. It's that simple. You see soybeans, for example, heck of a run up this year. So over last year, at least since last May, this CTN up 85%. So we break this trend line, then we pull back and we target drop back to 2150. That would be a healthy correction. Whether it came starting today and that's a 10% drop, or we go up here, we continue to diverge, see the negative divergence, and then we drop. So the point is we'll just take the charts one day at a time, and I might start to become, as I have recently, a little more actively trading or micromanaging the long-term positions in a lot of these commodities, where early on this was a strong run, you just wanted to hold on. I really wasn't highlighting many pullbacks along the way, but we're getting to that point where that we may start to see some pressure on the commodities, including the ag commodities. Longer term, the charts are still very constructive. Nothing has changed from that aspect. What I'm doing here is just soybeans. For example, we had major resistance right there. It was key support back here years ago, a major reaction high, and we just broke above it. So again, that would align with a pullback to backtest that level. And this move here is not a bear market rally. It's taken out previous lows. This is more indicative of early stage bull market action. However, nothing goes up forever. So there'll be corrections along the way. And if something changes, and it'll probably not be today, tomorrow, or next week, but down the road, if something in the charts changes and it looks like, hey, we're going to run down at the lows again, and maybe this was just some kind of convoluted bear market rally, we'll adjust and adapt. But as of now, like I said, let's just take these one day at a time and manage these trades based on both the 60-minute charts and the daily charts, like this one, that pullback, that was a major breakout, pull back to 650, and so far, nice bounce off there. A couple more things I wanted to highlight. I wanted to talk to you about the volatility indexes real quick, because I started out with the markets, and just want to make mention on VIX. This is the VIX, the main, most commonly tracked volatility index. I have a couple boards here. This one's a little cleaner and simple, and what it shows is the VIX is pulled back to this support level here. That's 1622. It goes back a ways to the left of the chart. Here, I'll show you. There's quite a bit of reactions along that level for years, going back many years, you can see as I'm rolling back. And so we just pulled back to support in a pretty decent bounce so far today. And and keep in mind, and I pointed it out here, and we did get a bounce. We had a pullback to that support level right here with positive divergence, and we rallied the VIX from that point, from that divergent low. It was about a 85% rally in the VIX. We've come back to that level, and it's basically another pullback there, and it keeps the divergence intact. So what you see is prices made effectively an equal low right there, and the indicators are continue to make higher lows. So this points to the potential for another spike up here in the VIX, and if that were to be the case, that would most likely coincide with a pullback in the equity markets. The VIX isn't the only one. I have an oil volatility index, OVX. Let me put on the levels there. You can see big support right here. Let me just stop scrolling right here. You can see for years now, this level, about 3087, especially in recent years here, has acted as support. So we're back to that level. And so remember, when you're looking at volatility indexes, the technicals are just the underlying in reverse. What I mean by that, for the VIX, it's a stock market in reverse. If you have a bullish setup in the VIX, that usually will align with a bearish setup in the S&P 500. Then if that bullish setup plays out, remember there's a difference between a bullish setup and an actual, actionable chart or a breakout. This tells you that the oil VIX right now is at support, and you could eventually go long, if you can trade these futures, so what you can do, or go short oil for a bounce off that. And the MO is typically you get to the bottom, you go to the top of the zone, which is about 70, 50 or so. You can swing up there. That would mean a drop in oil if that happens. Otherwise, you break it. Remember, support is support until unless broken, and if you break it, the next support's down here about 23.83, and that would coincide with a rally in oil. And we'll get to oil in just 1 second. I'm going to show you the chart, update that. RVX is the Russell 2000, the small cap volatility index. You have some divergence building on that as well. You have decent support down here about 23.28. We're a little bit above it right now. Then there's the VXN, which is the NASDAQ volatility index. That is also at support. So that's why I wanted to update these volatility indexes today. These are lines that have been here a while. Last time this line was created back in April of this year, about mid-April. And same thing as the VIX, the regular VIX, and that is a pullback to support with positive divergence right there. And we popped up, we had a rally, we pulled back to effectively come back into the same level, so prices are at equal levels, and yet the indicators are still making higher highs, so there's positive divergence again. And should that play out, we'll probably come back up here to at least these two targets right there, 25.55 and about 31, and quite possibly more. I could certainly add, and I should add some levels here in case we start to get some traction on any kind of correction soon. That's it. We have the VIX Apple. That's also its support. Apple's such a big stock. It's the world's largest. It's the largest component of the S&P 500, Nasdaq 100, and therefore it has its own volatility index, just like a lot of the indexes do. And that's back at support. 26 is the support. I highlighted it a few weeks back. That line's been there a while as well. Created back in back in May, about a month ago. I put that line on there. Now, and should Apple rally from here, break the 26 support, next support down there is about 19.15 or so. And that would most likely coincide with more upside in the market and more upside in Apple, which tend to go hand in hand. Okay, and then crude oil, again, we're on the futures charts. You had this level here I've highlighted recently, about 66.63, give or take. It's not a hard level because we had a spike through it there, a little reversal just below right there. But it seems to, well, it certainly has been resistance on crude oil, and that was mentioned right here as an objective short. It was mentioned again here, but that one didn't pan out. What happened? We made a marginal new high, but I did say it at the time that with the based on the posture of the charts, we could easily get another marginal new high, and if it's only that, that's pretty well above that level. So that's about where I want to see it stop, and I believe it will based on the technicals. And then what you need to see, you have a little bit of an uptrend line here. It's not super well defined, but defined enough to put it there, and there's a negative divergence right there. So what you have when you have negative divergence, that gives you this rising wedge pattern. So should that break, could take us back down there, and if we break well above that or well below 66.63, that will be, or this whole thing right here, let me circle it or square it in, that would be a false breakout, aka bull trap, and those are pretty bearish, and that would probably bring crude down to I think all the way back to at least 60.63 right here, and quite possibly down to that 57.64 level. I missed this one. Sugar was one of the other commodities. Again, this is kind of hit and run mode. This was highlighted as an objective long on pullback to support, and or on the breakout and back test of that falling wedge downtrend line. And nice lift so far in sugar, especially if you're trading sugar futures. And I gave you the ETFs and ETNs, which are, or ETNs, they're both SGG and CANE, C-A-N-E. Those are your proxies, and there's that same, when you go to the 60-minute chart, you'll usually see almost an identical pattern there, the bullish falling wedge, breakout back test, and a nice lift so far. And where they go from here, my convictions aren't strong. If you're still in those, maybe trail your stops up. Um, that's obviously in a bull run. You can certainly use wider stops if you're an investor and an active trader. Might want to use more aggressive stops. And last but not least, quick update on AMC because I mentioned that one back here recently as objective short at 20. It acted as resistance for about a day or so. It hit there that day, stopped it, but then took it out the next morning. And the way it works is resistance, once taken out, boom, then that's bullish. It should become support on any pullback. But we ran up, and at the time, I had these two additional potential targets slash resistance levels, 25, 80, and 36. The 36 is a big level. You go back, that was the all-time highs back here in 2016, 2017, and that's what we hit Friday to the button. I mean, almost to the button there. And so far we're below that. So we still have, as I said we would, if we took out $20, we did. We have negative divergence. It's unconfirmed divergence because these indicators are pointing up. They're momentum indicators, but should they turn down, and I like to see the bearish crossover right here on the PPO. I mean, that orange line would come down, cross below this white line, give us a bearish crossover, and then confirm the divergence. And that would send us back down to, I still think, at least that $9 ish level, with a couple stops certainly along the way. I suspect we'll probably come on right down through 20. That's good support right there, 1432. If you want a pretty shallow target, relatively shallow. I mean, that's, if you shorted the run to 36, that would still be a 60% drop, and if you get back down to the $9 level, that's about a 75% drop. All right, I'm going to wrap it up here. Keep it a short video. There's not a lot jumping out to me right now as far as objective entries, long or short. Nothing that screams, get in now at this point in time. I'm going to continue to look for trade ideas. Somebody asked me to look at the cannabis stocks that they're setting up bullishly. I plan to go through. There's quite a few of them. I want to confirm the sector ETFs as well as the individual stocks. And if I see anything there that's compelling, or of course anything else, I'll get it out to you today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.